First of all, it's been a great pleasure and honor to present and introduce risk in a reinsurance company's view. And once again, really appreciate for your generous participation in this K-ASEAN. To briefly introduce myself, my name is Michael Seok Gyou JIN. You could call me either Michael, my Catholic name, or Jin, my family name. Currently, I'm working in a Korean reinsurance company as an ERM manager. ERM means Enterprise Risk Management. ERM is the topic that we will explain you in detail from now on today. I've joined Korean since 2009 and thoroughly having experiences in risk and ERM wide. Just before we start to discuss details in reinsurance risk, we'd like to stress on two things. First, definition of reinsurance, and second, quick introduction of Korean Re. This could be very helpful to understand you more on risk and related measures. I might understand your backgrounds and understanding of risk varies, but for a quick and easy understanding of risk and reinsurance itself, I will explain from somewhat very basic to those of experts. Hence, please understand if we'll explain very simple one and easy ones. Well, let's start with reinsurance. In the word reinsurance means, and it is defined as an insurance company for an insurance company, not a personal or other people. Insurance is a business that an insurance company gets premiums from contractors and pay claims when an accident would happen. The type of insurance market is divided into two. The first one is commercial lines and second one is life and health. Life and health insurance are more familiar with ordinary people and is more like a B2C, businesses to customers. Commercial lines have several areas which is very closely related to industries. Property, which covers buildings and factories. Casualties, that insurance indemnity losses. Marine, aviation, motor insurance, which covers ships, airplanes, and motors. Commercial lines are more like a B2B. Suppose that one insurance company has a contract that covers an airplane. The premium will be calculated based on a historical airplane accident, which is very rare, but severe once happens. If this is the case, an insurance company would worry by not covering a claim alone when there is an accident, big accident, because airplane claims and passenger liabilities could be extremely high to covered by only one insurer. Hence, therefore, an insurance company need and find out another insurance company to cover it together. This another insurance company is called as a reinsurance company. It means insurance company for insurance company. From its definition, reinsurance is a separate contract between insurance company and reinsurance company, which covers indemnity liability from primary insurance company. By remembering the airplane examples, an insurance company, which is a primary insurance company, have some reasons to use reinsurance. The first and a very clear one is spread of its risk by sharing risk. Second, insurance company could increase the capacity by considering reinsurance backward. Third, an insured airplane company, in an example, could have higher protection because insurance and reinsurance company together cover its insurance contracts. Finally, reinsurance company has normally well-diversified portfolios and has better understanding of the market. Reinsurance company could support and introduce new products to insurance companies. The origin of reinsurance is known from 1350, Genoa in Italy. At the time, there was an insurance company that covered ships from Cadiz in Spain to Sluis in Dutch. And it is known that the insurance company had the first reinsurance contract with other insurance company. However, this is not an official document. From time to time, Lloyd's, where you might be heard of, the Lloyd's of London had been producing bulk of insurance contracts, and reinsurance had been also growing them afterwards. And from 20th century, following by a rapid industrialization, the insurance business could expand worldwide. World War II, First and the Second also influenced an expansion by industrial development afterwards. Up to now, we have defined what a reinsurance is, and from now on, we'll introduce our own company, Korean Re. Here you could see the global reinsurance rankings published by AM Best and S&P, which are credit rating agencies. Korean Re is the 11th largest global reinsurance company in the world based on 2020. Just 10 to 20 years ago, we were far below 30, but we've thrived and managed well our portfolios. We've reached our top 10 now. We at first were established as a state-owned reinsurance company at 1963. The name was Korean Non-Life Reinsurance Company, which is called as KRIC. In 1978, we reorganized as a publicly owned company, Korean Reinsurance Company. Thanks to the prudent growth and profits, in 2011 and 2014, we had credit ratings of A from AM Best and S&P. We have 25 units in headquarters in Seoul and 4 branches, 3 subsidiaries, and 5 liaison offices globally. 4 branches are in Singapore, Labuan, Dubai, and Shanghai, and 3 subsidiaries are Hong Kong, London, and Zurich. 5 liaison offices are Beijing, Tokyo, New York, London, and Bogota. Over the last few decades, we tried to have a dominant reinsurance position in the Korean market and continuous overseas expansion for developing new growth and profit engines. A Shanghai branch in China and a Bogota liaison office started businesses from 2020, and U.S. reinsurance broking company is targeting to open from October this year. We have dominant and outstanding market position in a Korean domestic reinsurance market, as shown below. Over the last few decades, we've been one of the top reinsurance market player in Korea. Well, this is the end of introduction of reinsurance and Korean Re. We will explain further about risk management at first. The agendas are like this, and let's start with risk. Comes up to your minds when you first hear about risk. Most industries, including banks and even economic field, risk could be considered as uncertainty. It means a probable loss which requires a sufficient capital to cover. Most of or all companies are very afraid of being uncertain. It means its profitability and sustainability is in question. Therefore, industries are studying statistics to analyze and minimize those uncertainty. Normally, these actions require to analyze difference between plan and actual, and historically, many companies are focusing on control the risk. They are focusing on control. However, especially in a reinsurance market, additionally, we are considering risk as a source of our profits. Reinsurance company could price a risk. Reinsurance company takes a risk by calculating and accepting premium. To make it clear, we model a risk by using various statistic tools. We accept premium only when we think a premium would be sufficient to cover a potential risk that we calculated. And then we are managing risk rather than controlling risk. ERM, Enterprise Risk Management, is an overall and comprehensive related activities that a reinsurance company dealing its overall risk. We are going to explain ERM in the next chapter, and here just focusing on risk itself. The key activity regarding risk is capital management. In a reinsurance company, main operating activities are investment and reinsurance business. We are pursuing profit in all of those areas. By doing so, we could earn a profit and increase our capital. Capital is the same meaning with surplus and net asset. Then, what happens if risk is triggered? This means we are facing a capital deficiency or a bankruptcy when an unexpected risk is triggered. There are some actual and financial examples that you are very familiar with. The first one is the collapse of bearings. This case is a very famous one to explain a fraud risk of one trader. A trader named Nick, and he was only 28 at the time. He was a derivatives trader, and he had built a position where he earns some, very little, when there's a low market volatility, and experience loss a lot when volatility would be higher than expected, either long or short. Unfortunately, there was a Kobe earthquake in Japan at the time, and the volatility increased dramatically, and Barings experienced 1.4 billion losses, which is 2 times higher than his capital. And finally, Baring is sold to ING only for $1. The second example is the subprime mortgages. Subprime is called as a grid of financial engineering. By accumulating and structuring, even subprime mortgages could have a higher or highest credit ratings. A lot of investors were eager to invest in subprime in the belief that the price of property would be never fallen down. And afterwards, as you might be fully aware of it, subprime loan boomed, and AIG, who sold a lot of credit default swap CDS, experienced super abnormal losses backed by FRB in the United States. The last example is 9/11 attack. Most people are well acknowledged about it as an airplane crash and collapse of buildings downtown New York. But in the reinsurance market, 9/11 is one of the horrible and biggest insurance events. Total claims were around 40 billion US dollars, including business interruption, BI, life, an airplane, and property itself. Some of insurance and reinsurance companies experienced very severe loss, and they started to review terror exclusion wording afterwards, which the reinsurance companies could not pay claims for the terror. So how a reinsurance company cope with those risks, and how to define it, and how to calculate it. As explained earlier, risk is controlled by capital, asset minus liability, which means net asset. For your easy and clear understanding, we are going to show a quick and very simple examples. Suppose that we've set up a reinsurance company named as K-ASEAN last year. It opened up with capital of 200 and approved by regulator at the time. And suppose that it earned 200 last year, just for the quick understanding. And starting this year, current status of this balance sheet BS, it's asset of 500. Liability and capital is also 500. Insurance receivables and payables just increase as K-ASEAN runs a business. They are very similar with payable and receivables in our manufacturing businesses. And during this year, suppose that at the end of this year, suppose that we are at the end of this year, K-ASEAN runs the businesses with premium 300 and its related claim payment 150, and another insurance cost would be 100, then overall insurance profit is 50. And by investing bonds and stocks, its investment profit is 100. Hence, overall total operating profit is 150, and net income after tax is 100. Suppose that tax is 50, and this 100 of net income could add up to the start of next year's asset and capital in balance sheet increase, same as 200 increase at the start of this year. Based on these circumstances, what type of risk is K-ASEAN is facing in terms of risk management purposes? While it could experience market crunch, which causes an investment losses, and counterparty defaults, where it could not collect money from other insurance companies or reinsurance companies. Therefore, the European and American and even Korean regulators are set up and define risk based on their experiences and the importance to their reinsurance companies. Here, we're going to talk about market credit and insurance. Those three are the most common, and correlation effect is an integration method to overall risk calculation. Well, let's go back to the example. For market risk, we define it as an unexpected losses that comes up from an investment market changes, such as interest rate changes and stock market crash. Suppose that risk charge for bond is 5% and stock is 10%, and we invested 300 in bond and 100 in stock. Then the market risk is calculated as 300 multiplied by 5% in bond and 100 multiplied by 10 is stock, which concludes in 25 in total. By sum, we define credit risk as an unexpected losses by counterparty default or not paying receivables. If suppose the risk charge for the reinsurance receivables is 5%, then the credit risk for receivable is 100 multiplied by 5, which is 5. And there are two types of insurance risk. One is premium and the other one is reserve. Premium risk is a risk that pre-calculated premium is not enough for covering claims, which means underestimating premiums. It could be calculated by premium multiplied by predefined risk charge for premium. Premium for this year was 300, and suppose the risk charge for premium risk is 5%, then the premium risk would be 15. 300 multiplied by 5. Reserve risk is the payable, which we've calculated previously calculated, is smaller than actual payables. It's another risk that we have to pay more. Suppose that the payable risk charge is 5%, then our payables, our reserve risk could be 100 multiplied by 5, which is 5. In this regard, we have 25 of market and 5 of credit and 20 of insurance risk as shown, just in sum. Then what would be the total risk for K-ASEAN? As a simple sum, it could be 50, but in an actual view, the pre-described risk is not happening at the same time. We call it as a diversification effect or correlated risk. By adapting this correlation effect, suppose that is only 20, our total risk could be 30, as shown. By calculating and measuring risk, a reinsurance company could control its capital level and plan a related business strategies. The key of reinsurance business strategy, hence, would be a strategic business management with a prudent forecasting for maximizing wealth to enhance a long-term business goal. Also, a reinsurance company could pursue a sustainable and stable income generating by controlling its risk. And a reinsurance company could avoid massive losses, thoroughly analyzing its return and risk profiles. Overall, by enhancing risk management itself, a reinsurance could expect a prudent and stable profit generation. The scope of risk management are from insurance risk-taking to investment deliberation, and risk could use for early warning where there's a pre-set up a signal for change profit, and risk measures and could use capital allocation, including limits management, and finally, risk could use in RAPM, risk-adjusted performance measurement, which calculating relative performances based on a risk upon return. This slide shows how we define a capital with different view from accounting and available capital, insolvency, and required capital. We explain further details later on in this capital. And one thing you have to remember, and I'd like to stress on, is required capital. It's a risk. It can be read as an economic capital and required capital for solvency purposes. Those three could be very similar. From now on, we will review the concepts of risk, economic capital, and required capital. Briefly, it could be understood risk arises by all of the business activities. As some of you might be acknowledged, risk is a kind of statistical concept. In the distribution, we have to review EL and WC. EL is an expected loss. It means expected value based on a best estimation. To make it very simple, it's very close to a statistical mean. WC, though also called as solvency standard, means the worst case values. It means 1 in 100 years or 1 in 200 years defined by company or regulator. The time horizon where a worst case happens is normally 1 year. The gap between WC and EL is what we call as risk, similar to required capital and economic capital. Then, why do we need to calculate a risk, the economic capital? It's mainly because we have to survive in a worst case covering by our capital. Suppose that we have experienced a 1 in 100 year earthquake. We also call it as a 99% confidence level in a certain year. If we prepare the sufficient capital covering the loss, then our businesses could be ongoing. If not, will be disappeared. That's why we are very cautious about calculating the 1 in 100 year risk or 99% of economic capital. That is why we are focusing on calculating a capital and consider it as the first and the most important step for risk management. In this regard, we will introduce on 3 key areas for risk management. The first one is solvency management, the second one is capital modeling, and finally ERM itself. In solvency, we will talk about available capital and economic capital in terms of the solvency ratio, and capital shield strategy, which encourage a reinsurance company to control a proper solvency level. In a capital modeling, we will introduce you a basic concept of a standard and internal model and some inspiration of CAN model, catastrophe modeling. And finally, in ERM, we are going to review risk strategies and real ERM practice examples. Well, up to now, we introduced you a basic concept of risk that reinsurance companies are confronting. And here we're going to have a short break and we'll discuss more about solvency, capital, and ERM in due courses. Thank you.